Good afternoon, ladies and gentlemen. So thank you for being here. So first of all, I would like to apologize because I don't have a tie for this presentation. The reason is if you have read Nassim Taleb's book, so The Black Swan, you know that Mr. Taleb hates ties and suits, especially when you have an economist or a banker inside. So I'm not really an economist, but it's even worse today because I'm going to talk about forecasting black swans, which is supposed to be impossible. And I will show you that with some technical tools, we can forecast at least a certain type of black swans. So the main topics I will talk about today, I will, as an introduction, I have been a sell-side technical analyst for 20 years. So I would like to share with you the work of a sell-side technical analyst on a daily basis and the typical question I get from my clients, which are only professional investors. So in terms, we saw several presentations on behavioral finance this morning, and it will be quite interesting to see what's happening in the training rooms. After that, so I will make a brief definition. I will remind you what a black swan is, so it will be very quick. I will talk about trend following tools and why I think it's one of the best methods trend following to anticipate black swans. Then I will show you several case studies talking about point and figure charts, which is the main topic of today's presentation. So first of all, as an introduction, I would like to comment with you 3 market mantras. So the first one, you already know it. I don't need to spend a lot of time on it. So financial markets discount everything. The second one is also quite interesting. There is a saying that most people making a lot of money on financial markets are contrarian investors. It's probably true. But my feeling is that making money being a contrarian investor is not so easy. And sometimes you can even lose a lot of money, especially if you are a long-term investor. So if you are a long-term investor, I think trend following is a good way to make money as well. I mean, if you are a contrarian investor, I think it's very, very important to have extremely good money management rules. The last mantra is today's topic. So don't try to anticipate black swans. I will not answer to, I will just comment in depth this mantra, but just as a starter, I mean, if financial markets are really discount everything, then in a way we should be able to forecast some of the extreme events. Not all of them, but some of them. So a last quote from Paul Samuelson. So the same thing, it's very popular. You already know it. What it means, forecasting 9 out of the 5 recessions, is that as a technician, you will always have false signals in the market. I mean, the market is very good to discount economic downturns, upturns, 6 months in advance on average. But if you rely on market trends, then you will always have false signals. So in some cases, you will lose money if you do trend following. The second quote, which is in the cartoon, is quite interesting. It was a special one for Nassim Taleb. I think he would have loved it. And as you can see, Mr. Samuelson is not wearing a tie, so he's a pretty cautious economist. So just to answer to the question, can we forecast black swans with trend following tools? So here you have a good example in this study, so which was a study published by Jorion and Gottsman a few years ago. A very interesting report, if you have the opportunity to read it. It says that on average, when you have a market interruption, which could be, and sometimes the market never reopens, which was the case, for example, in Portugal in 1974, then if you are a trend follower, you are out of the market since a long time. Because on average, the market is down 20% before the stock interruption, so from a year-to-year basis. So markets, this is the best proof that markets do discount a certain kind of black swan. So because, I mean, a market interruption is obviously a black swan. Because from one day to the other, you lose everything on the market. So my daily work as a technical analyst, it's a bit like this man. I mean, I don't have the same glasses, but I mean, it's a tough job because every morning you wake up quite early and you have to give some news to your clients. So what they expect from me is to tell them what the market will do today. And the reality is that I don't know. I'm like you. I don't know what's going to happen. And I have to give them some answers of what the market will do today, this week, this month, whatsoever. So to do my job, I mean, I developed a methodology, a roadmap, because what clients expect from me is to be right more than half of the time. So I created my own roadmap, which fits to my character and over time. And I started to include point and figure charts, even on an intraday basis, let's say 2 years ago. And since I introduced point and figure chart in my trading strategies, I was really, I improved a lot the results of my trading models. So before commenting this typical question I have from my clients, so I'll switch it off, I would like to ask you people who would like to buy today equity markets. So it could be the S&P and European markets. So put your hand up if you want to buy the market. So 2 people, 3 people. Very few people want to buy the market today. Who would like to sell it? There are more people who would like to sell it and who would like to be out of the market today. Yeah, okay, so I see that most of you are more trend follower here, so that's the good place to be. Because this presentation is all about trend following. I mean, the typical question I have from our clients are more contrarian questions. I mean, most of the time my clients, they want me to give some insight about where a bull market can stop. Is it overbought? What should I do? Should I lighten my position? And in the downtrend, it's the reverse. So the question I have most of the time are more contrarian than trend following ones. My feeling is that contrarian thinking is good. You can make a lot of money. But the problem is trying to anticipate turning point. And I think it's the most difficult thing to do, not only in technical analysis, but in finance, anticipating the end of a trend on the market. The reason is that I always hear some people talking about overbought markets, oversold markets, and the reality is that an overbought market is usually an indication that the market will go higher, and an oversold market is usually an indication of a weak market. The other message I want to give you is that I think most people expect probably too much from technical analysis. Technicians can add value to your trading, but you have to use them in the right way. And for me, the right way is a technician is able to see what's going on the market. So not what people are saying, but what they are doing. I mean, for example, over the last couple of weeks, I started to see some pretty bearish price action. I haven't seen really changes in fundamentals of the market. But as a technician, it sounded like an alarm bell to me because I saw potential chartist patterns. So John Murphy talked this morning about head and shoulder on the DAX. I was watching at this pattern since approximately 1 month, and every morning I was waking up, okay, so this pattern is becoming more and more probable. So this is what a technician can bring you. So a survey of the market, so of opinion. And so it's more or less to characterize what markets you are trading. Is it an uptrend, is it a downtrend, or is it a sideways market? Something very important when you ask a question to a technician, please do select your time frame because I can give very different answer depending on the time frame you are trading. So next question, how do we make money in the long term? I have 4 possible outcomes to make money in the long term. The first one is the buy and hold approach. So that's not really what we are doing in technical analysis because we are paid to do market timing. And I added prey because when you can make a lot of money buying the market and holding it, but the problem is that you need to have the right stocks and the right countries. If you don't select the leading stocks and the leading countries, you will not make money in the long term. So personally, I tried to pray a lot. It never worked. So that's why I became a technician. Mr. Bernanke is a bit more lucky than me. So next one. So the next possibility to make money in the long term is probably to be a market insider. The problem is this. So you have to take your risk. The third one is to be a genius. I mean, I would have liked to be a genius. I'm not one. And my feeling, according to what I heard this morning on behavioral finance, is that even geniuses are not sure to make money on the market because they have the same psychological bias than everybody. So if you are not in these three categories, the only thing you can do is be disciplined. And as you already know, being disciplined is not so easy. I mean, everybody can make money, be disciplined, but you have to stick with your rules, which is very, very difficult. So if you're not Warren Buffett and if you don't want to go to jail, like what's on the cartoon, then I suggest you to use trend following tools. Why? Because this way you will be able to keep your losses small. And more importantly, you will be able to stay with the trend. So make money when you have unexpected positive events, which is probably even more difficult than losing money. So this is a typical black curve. So another way to explain what I said. So what we want to avoid is the left part of the distribution curve. This is the unexpected high return. So we want to cut that, and stop losses are part of the system. And we want to catch this part, which are abnormally high return. And if you don't use a trend following tool, I'm not sure you will be able to catch these abnormally high returns. So very quickly, very briefly, a definition of black swan. So a black swan is an unexpected event, so an extreme event that by nature cannot be anticipated. So as you can see, I put negative black swan, so on the upper part of the slide. The first one, so Fukushima, is for me a real black swan because anticipating a nuclear problem following an earthquake was almost impossible. I mean, that's the butterfly effect. It never happened before, and that's something that was unexpected. It's a real extreme event. What happened, the 9/11 attack are not real black swans because for Al-Qaeda terrorists, it was something expected. I mean, it was a black swan for US citizens, but in a way, it was not a pure black swan. Just a reminder, you also have positive black swan. That's what we want to catch on financial markets. For example, when Mark Zuckerberg created Facebook, he started for fun. I mean, he didn't want to become a billionaire. He just wanted to have fun. Just a warning before I talk about trend following. So you all know that you will lose money in trading range. So trend following is not the best way to become rich. Sometimes it's good, sometimes it's bad. It's like all technical analysis tools. So the technical indicators that can help you to do trend following, you have plenty of them. So I put some of the indicators I use in this presentation. I will focus on the last one. I will explain you in 2 minutes why. But just an advice before I go to the next slide. One very, very important advice, don't use all these indicators at the same time, because here is what will happen if you use all of them at the same time. This is a real chart. I found it on the internet, but I'm not sure that if I show this type of chart to my clients, they will be very happy. So now I'm going to focus on 3-box reversal point and figure chart. So a lot of people, I mean, not in the technical community, but more on the fundamental community, always spend their time criticizing technical analysis because they think it's too subjective. And my understanding is that, in a way, it's true. Because if you look, for example, at chartist patterns, I mean, you show a chart to 5 or 10 technical analysts, you will not get the same result from these analysts. So some of them will see a potential continuation triangle, others potential major top formations. I don't know why, I don't know exactly what, but we have our own vision of the market. What I like with point and figure charts is that they are almost quantitative tools. So you show one point and figure chart to 10 technical analysts that know how to use the chart. You should just get 1 or 2 answer max in terms of forecast. So what I like with this type of point and figure chart, they give you clear targets, and that's very important. It's a low pass filter, which means that it erases noise, so you just keep the signal. You have less lag than simple moving averages. And also, I really like these 45-degree trend lines because you need just 1 point, and I know no other technique that are able to do that. You just need 1 point to define a trend. So very briefly, how you draw a point and figure chart. So I use a 3-box reversal chart, so 1 by 3. Here you have a bullish column, so we went from 10 to 13. If we go to 12, we do nothing, because it's an asymmetric filter. If we go to 14, you plot 1 additional cross. If we go up 1 point more, you plot another cross. And if we go down 1 point, you do nothing. 2 points, nothing. 3 points, you start another column with 3 O's at the same time. This is the asymmetric part of the filter. So 1 point up in an uptrend, you do something. 1 point down, you do nothing. You need 3 reversal box. Same thing on the upside. So to print a new X column, you need 3 points up at the same time. Below 3 points, you do nothing. So if you want to learn more about point and figure charts, so I really like this book from Jérémy Duplessis. I really encourage you to read it because in this presentation I will not have time to develop all the theory. It's very complex. Just a chart from this book. Why are we using 45-degree line? I think it's very important because I will talk about this a bit later in the presentation. It's very simple. I mean, to get an uptrend in technical analysis, you need to get higher lows. This is what defines an uptrend. And to get higher lows on a point and figure chart, you need to have 5 box up, then 3 box down. If you don't have that, for example here, 4 box up, 3 box down, then you don't have an uptrend because the 2 columns are at the same level. So and if we do this, on a 3-box reversal chart, you do have a 45-degree trend line. So the most subjective part I warn you about a point and figure chart is probably to choose the box size. Because I cannot choose it for you. I mean, it will depend on the volatility of the market. So the more volatile the market is, the higher the box size. And it will also depend on your time frame, because if you choose a small box size, you will see plenty of whipsaws. So your turnover on the portfolio will be higher. So personally, I usually make recommendations on equity markets. So I follow mostly equity and indices. Most of the time, I like to use semi-lux scales on equities with box size around 1%. That's my my preferred setting. For short-term views, I like to use 0.5%. And when you have a very volatile stock, so we see a few of them after that, I use 2%. If you want to do a point and figure charts on intraday charts, always use linear scales. semi-log scale don't make sense. And something very important, when you use a daily point and figure chart, some people say, okay, I want to look at weekly or monthly prices. It does not make sense for a point and figure chart. So if you want to look at the big, broad picture, always use daily data, not weekly and monthly one, because you will lose too much information. So now I'm going to talk about, to show you several case studies. So I will start with 3 French stocks. 2 of them, you probably already know them. It's Alcatel-Lucent and Alstom. And I will show you a third one, which is Air Liquide. So in here, as it is a very volatile stock, I decided to take a 2% time free box size, so daily close. So the question I will ask at the start is, okay, what is the trend on this stock? So I mean, most of you will say it's down. But the problem is that when you look closer, it's not so simple, because you have a downtrend here, uptrend, downtrend, uptrend, downtrend, and since last year, a new uptrend potentially starting. So identifying the trend, I mean, is not so easy. And that's always, you have always a subjective part, because at the end of the chart, we don't know if it's the start of a reversal or not. So you have a lot of subjectivity here. So if I add this famous 45-degree line on the chart, so you will get this chart. So here you have a potential start of an uptrend, because we are breaking below the declining trend line. Here, a potential start of a downtrend, bullish reversal here, bearish reversal here, bullish one, bearish one, and in 2012, new bullish one. So as you can see, you will tell me, okay, this is a great tool, but I'm losing a lot of performance at the top, because I'm not staying at the top. And here, the signal is pretty bad. Same thing here. Here, okay, the signal is good, but the trade is not close. So the results seem pretty disappointing. So what I would like to show you is the results of a backtest using this strategy. So I'm going long when you have the blue arrows, and I close my long, which means it's a long-only strategy, so I don't want to go short. I close my long when we have a red arrow, so when we break below this trend line. So here you have the result of the backtest. So this is the equity curve here. So this way, I mean, I'm not catching the extreme points, but as you can see, I'm out of the market during a very volatile period. So here I'm in cash. And over that period, so the stock is down 90%, and I'm making 75%. So incredibly good results. So this strategy is extremely simple. And I'm making a lot of money on it. And more importantly, I didn't lose everything, because if I was long the stock, I would have lost everything. Another one is Alstom. So you have exactly the same chart with the same parameter. There is a difference between Alstom and Alcatel. As you can see, there are more whipsaws. And as I told you at the start, whipsaws are extremely bad for most trend-following tools. So I'm supposed to lose money in these periods. And here, as you can see, it's pretty difficult to catch the trend reversal, because prices were very far from their 45-degree trend lines when the reversal occurred. So we lost a lot of performance here. We bought here, we made money, and once again, here the prices were very high compared to their 45-degree line. So once again, we lost money before we had the sell signal. So if I show you the results of the backtest, it's not so good. I mean, it's better than buy and hold, which means that you would only have lost approximately half of the value with this strategy compared to 90% on the stock. So not too bad, but a bit disappointing, I would say. The third case is on Air Liquide. So this one is very different from Alcatel and Alstom. First, because it's a leading stock. Secondly, because it's low beta stock. And my feeling is that most technicians, they don't like to trade this stock. And I will show you why. Because we have a lot of whipsaws. So catching a trend in this period is almost impossible. Then you have a pretty good trend here, but we are losing performance here during the reversal. Then here you have an uptrend, but you have more whipsaws, so not a good stock, I mean, for trend following tools. At least not for point and figure chart with a 1% time free box size. So if I show you the results of this backtest, so I made the same backtest, we are losing money in this period, which is not so surprising. Then we had a good run. We lose performance here during the reversal. Then after that, the performance is medium. So overall, I would say that in a stock that made a very, very good performance, the results of the backtest are extremely disappointing. So if I try to summarize the conclusions from these examples, I would say that point and figure usually give better results when you have trending markets or not too much whipsaws. They are better, in my view, in highly volatility. You can adjust the box size, but I mean, making money on Air Liquide, beating the buy and hold on Air Liquide was almost impossible to do. More importantly, that's, I think, the great, what is great with point and figure chart, you will be out of the market during bear trends. And in bull trends, you will be long and following the rise of the market. So the inconvenience, we already talked about that. So now I'm going to focus on the main problem I highlighted you, which is at the start of a reversal, what can we do to reduce this drawdown? Because here, this is the chart of the Euro Stock 50 since 1987. So as you can see here, we were very high. This is the top of 2000. Here you have the top of 2007. We are very far from this 45-degree trend line. And you lose a lot of performance here before we have the sell signal, which is the break below the 45-degree line. So if I show you, same thing, the backtesting of this strategy, so long above the 45-degree line and out of the market below, then it's not so bad. I mean, I'm out of the market very often. So when you see a flat curve, it's because I'm out of the market. And in the long term, I beat the buy and hold, which is very good. I mean, because the market was volatile. What is pretty disappointing, so in terms of Sharpe ratio, my strategy is much better than the buy and hold approach, much, much better. However, I'm a bit disappointing because I lost 50%. This is a bit less than the buy and hold, but it's still 50%. So it's quite significant. It was a bit better in 2007, 2008, but it's still 25%. So I tried to improve my model, introducing short selling. So I call it model number 2. So I'm long when I'm above the ascending 45-degree support line, and I'm short when I'm below. The results are not much better. I mean, we are back to new highs, so it's a bit better compared to the high of 2000. But I mean, we are making less money on the long-only trading model, and being invested in the market all the time. So the volatility of the system is, of course, above that of the buy and hold of the long-only approach. So overall, I would say that I made some backtesting in downtrend, and I found that results of point and figure charts in the bear market are less impressive, because usually you have the squeeze at the end of the downtrend and you lose a lot of performance. In an uptrend, it's more a slow move, so the market is moving more slowly, which is which is much better from a point and figure point of view. So how can we reduce this drawdown? Big question, and I found some solutions. The first one is to use what we call internal trend lines. And combined with a point and figure pattern. So I will show you a few examples of how we could have avoided being long after the top of 2000. We can also use contrarian indicators combined with trend following tools. So I will keep using these 45-degree lines. Then you can also use moving average and MACD on point and figure charts or any other indicator. So if I try to combine internal lines with point and figure patterns, so here you have the top of 2000. So the lines in blue are internal lines. How do you draw an internal line? So usually I like to start from a mini bottom. a mini bottom, so you get this bottom by having at least one double bottom breakdown, so which is a bearish reversal, followed by a double top breakout, which is a bullish reversal. So you have a potential trend reversal here, then going up again. And this defines a minor, so a mini bottom. And as I told you during the introduction, when you just need 1 point to draw a 45-degree line. So this point is enough to draw this internal trend line. So in an uptrend, you are supposed to have higher and higher internal trend lines until, and then when we break below this internal trend line, so the highest one, this is an indication that you are losing momentum on the market. So I try to combine that with typical patterns. So you have a nice one called fulcrum top here. This took a long time to draw this pattern. Then you had a breakdown here. So a breakdown below this support zone, which was the first indication that the trend was about to reverse. And later on, so we had a technical bounce attempt, which stayed below these 45-degree trend lines. Then we had a break below this internal support line with what we call a triple bottom breakdown, which is usually a very powerful sell signal. And what is quite interesting is that at this point, you are able to get some downside targets. So you have two downside targets. The first one is an horizontal one, and the second one is a vertical one. So you have a cluster of targets. So you already know that the bull trend is at risk. We don't know if the targets will be reached or not. They were, actually. But you already know that there is a warning. There is something, there is an alarm bell in the market telling you that the market is weakening. And I didn't plan to talk about today's market today, but I mean, what happened since last week is incredible, and that's exactly, we saw a fulcrum top last Friday. I won my client last Friday on the Russell 2000, so I had a sell signal very similar to this one. I don't know if it's the start of a bear market or not, but right now I said to my client, okay, the market is starting to lose momentum, so be careful, and don't try to buy the dips too early. The DAX also validated a quadruple sell signal. It was 2 days ago. And this is in line with this head and shoulder formation. So one other warning, and I have very low targets. So two targets like here, one vertical, one horizontal on the DAX. So if I show you the tops of 2007 and 2009, so you have similar trend reversal. So another fulcrum top here on the Euro Stoxx 50. Downside target here, another one here. A break below the first internal support line with a double top breakdown. So this was the first warning here, that the trend was potentially about to reverse. And here at the bottom of 2009, so we had a significant reversal, same thing. First break above this internal declining support line. A resistance line, sorry. Then there was a target here, which was reached several months later. The low of 2011 was also, the high of 2011 was also quite interesting, because here the prices were not far from the 45 degrees line. Then we had a triple bottom breakdown here, with a downside target here that was reached very, very quickly. So now I would like to introduce a third model, so third trading model, to try once again to reduce the drawdown of my Euro Stoxx 50 chart. When I am above, so when I'm in a bull trend, so above this 45-degree line, I would like to buy when we have a double top breakout, and I would like to sell when we have a double bottom breakdown. So what's a double top breakout? This is it. So I mean, I'm buying at 15, so we break above the previous high of this X column, which is a bullish column. So here I'm buying. This is a breakout strategy. So it's not at all a contrarian trade. And in this case, I'm stopped out, because after that, I get a bearish reversal. So I'm stopped out here. So I'm buying around 15, and I'm selling around 11. So if I apply this strategy to Euro Stock 50, so the results are pretty successful because I lost 33% from the peak of 2000 instead of 50%, so it's significantly better. But the disappointment is over the last 4 years, because as you see, I lost a lot of performance here, and the trend was, I mean, it was sideways, but obviously I underperformed Euro stocks. And I will explain, it's very clear why I had such bad results on Euro Stock 50. If you trade a trading model on Euro Stock 50, you already know what I mean. I mean, here you had extremely difficult market conditions, whipsaws all the time, so a breakout strategy was not able to catch performance on European stock markets. If I show you the results on the same model on Euro S&P 500, it's a different story. Because here we have a very, very powerful bull trend. So just to let you know, the last signal I had from this trading model, so which was a double top breakout, was in December 2011. So since then, not a single double bottom sell signal. And just to let you know, we are very, very close to having this double bottom sell signal. So it would close a long trade, which has been open since late 2011. So I tried once again to do to backtest a short strategy. So I took the reverse conditions. So in a downtrend, I tried to go short on the double bottom breakdown, trying to buy back my short on the double top breakout. So as you can see, I'm making performance. But it's a bit disappointing because sometimes I'm losing all my performance during the squeeze. So this is the famous squeeze I told you, because at the end of a downtrend, you always have very strong, very wide column, and you are losing a lot of performance at the end of the downtrend. So I prefer to use for buy and for long only strategies. So I will very briefly show you 3 additional techniques. So this is one, so I put these famous 45-degree lines on a bar chart, and I tweaked my RSI. So I think it's a quite nice way to look at point and figure. So this is my trend. So it's more or less my stop loss for the long position. And here I'm buying the dips each time the RSI is oversold. So in a bull trend, I don't have the same settings. So for me, I want to buy RSI when it's below 40. And I want to sell RSI when the market when RSI is above 80. So here, with these settings, you can see that I never had a sell signal on the RSI, which is pretty surprising for a contrarian approach. And I had plenty of opportunities to buy the dips here, and most of the signals were pretty accurate. Same thing in the downtrend here. So as you can see, my conditions in the downtrend are overbought RSI at 60 and oversold at 20, because I don't want to buy a falling market too early. The other way, I mean, what is more reactive than these trend lines are MACD. So you can plot an MACD on a point and figure chart. It's possible to do that. Sometimes the signal will be better than on trend lines, sometimes not, it depends. You can also use moving averages. For example, the basic rule would be to go long on a double top breakout just if we are above this moving average, and short if we have a double bottom breakdown below this moving average. So now I will finish the intervention answering to the question, could we have avoided some negative black swan using all the tools I showed you? So I didn't try to do optimization, or I just wanted to show you exactly the same parameters and doing some backtest on critical period of the history. So I selected the crash of 1987, the crash of 1929, and I will end with some comments on the Greek stock market. So here, you can see that at the end of the bull trend, it was at the fall to 1987, we had a double bottom breakdown here. And this was on 8 October, 10 days before the stock market crash. And we validated this triple bottom breakdown at the open of the crash. So the answer, at first, can we have avoided with point and figure charts? Can we have avoided the stock market crash in 1987? The answer is yes, because we had the first warning here, and in the morning of the stock market crash, you know you shouldn't buy this market. I mean, the market is opening sharply down, but with this chart, you know it's not a market to buy. What is quite interesting to use, I mean, we saw a market profile presentation this morning. Point and figure can also help to identify congestion area quite easily. The quite important point in 1987 is that the 45-degree support line, which started in 1982, was never broken. So it was not a real bear market. So if I show you the results of, I called it my strategy number 3, with the double top, double breakout strategy on a 1% time 3 box size. So it's here. So here, as you can see, I'm out of the market during the stock market crash. What is quite interesting is that I'm losing money after the stock market crash. So the reason why I'm losing money after is because you have whipsaws. And as you know now, when you have whipsaws like this, you're losing money with trend following tools. Anyway, the max drawdown I had from my trading strategy was minus 23%. You would have lost 40% as a max drawdown on the stock market crash. So I prefer to have this model and losing in 1988. So as I told you, you can do fine tuning. So this was a 1% time 3 box size. You can also look at the 0.5% time 3. If you're not sure of the reversal, so I told you 10 days before the stock market crash, we had the double bottom. So what happened on this smaller box size chart? There were more warnings. So a first double bottom, then a second one, then a third one. So you had 3 opportunities to exit the market here from this chart. And as you can see, on this double bottom sell signal, there was already a quite low target, which was hit at the start of the stock market crash. So here, I mean, it's difficult to go short here, but at least you have to be very careful about keeping longs on this market. So same thing, if I look at the backtest on the 0.5% time 3, I have a pretty similar picture than on a 1% time 3 box size. As I told you, the 45-degree line, so we have here the 1987 crash. This line, this support line was not broken. It was not either on 1990. And it was broken in the end in September 2002. So according to this point and figure chart, the bull market lasted 20 years, which is a very long time. And for 20 years, we never had a break below this support line. So now, if we look at the crash of 1929, it's quite similar. I mean, before the crash, we had, so I selected a 1% time 3 box size as well, like in 1987. So we had a first double bottom breakdown, a second one. There was a target, so I put it here, and the stock market crash. So the picture is quite similar. There is a big difference between 1987 and 1929. Is the break below this 45-degree line, which signaled, so it was 1 year after the stock market crash, which signaled the potential start of a real bear market. So I selected, so this is the backtest of my strategy number 1. So I'm not using double bottom, double top breakout. I'm just using trends. This is why I'm long during the stock market crash, because we are above this 45-degree line. But anyway, I'm out of the market between late 1930 and early 1933. So I was able to save some money being out of the market when we had the real bear market here. If I switch and go to the strategy number 3, which is with the double top, double bottom breakout, here you can see that the drawdown is less, but it's still 33%, but the max drawdown is much better. We've lost half of the value when the index lost almost everything. So having a loss of 50%, you can recover from that. Having loss like this, it's almost impossible. Once again, if I go to the 0.5% time free box size, we had warnings before the stock market crash, one double bottom, two double bottom, a downside target which was very low, and it hit during the stock market crash. So now the last example will be about Greek stocks. The question is, could we have been able to avoid the Greek bear market with this type of strategy? And the answer is yes. So as you can see here, we had a breakdown on below the ascending 45-degree support line in September 2008. So quite early in the downtrend. Quite interestingly here, we had a technical bounce right on this 45-degree resistance line, then the start of the real bear market. And more importantly, at the end of last year, and a potential end to the downtrend. So if you want to buy the Greek stock market, it's better to do so since the end of last year. I mean, as long as we are holding above this support line. So this was a chart I published a long time ago. We are probably not far from these 45-degree support lines again. So if I show you the back test, so strategy number one, so I'm just long above the 45-degree support line. As you can see, it sounds pretty bad. But if you were invested in the Greek stock market in 2000, so it's a bit like in the USA in the 1930s. The index was down 90%. And right now, you're not losing money. I mean, if you bought the market in 2000, you are almost flat, which is a great performance. If I look at my double top, double breakout strategy, so strategy number 3, we are even making money since 2000 on the system. And the funny thing is that, I mean, it's not funny, but that's what trend following tools are, is that I avoided most of the bear market here, and I'm losing money since the end of the bear market. That's exactly the same story than after the 1987 crash, because we have seen a lot of whipsaws since the end of last year. So in this context, you cannot really make money with trend following strategies. So the conclusion of the presentation is to show you that I hope I succeeded. I was successful. It was to show you that point and figure can help to be objective, can give you insight to my clients. I mean, when I talk about a chart to my clients, I show them the chart and they are able to understand what I mean. And for me, it's very important. So being objective on the analysis I make. It also helped me to improve discipline because I mean, I have the same bias than you. Sometimes I have fear. Sometimes I'm overconfident. And the point and figure chart always helped me to say, OK, are you making a mistake here? What's the story here? And that's the real objective part of the story. And believe it or not, but since I have started to use point and figure charts more intensively, I'm sleeping much better at night. Thank you very much.
We've probably got time for one question if someone's got a question. Any questions for Cyril? Valerie's got one.
Thank you, Cyril. The lines that you have used to backtest your models, were they drawn automatically by the software, or did you draw them?
You mean the 45-degree lines?
Yes.
The reason I use them is that they are drawn by the software. So because I don't want to, I mean, if you use one box reversal, then you can draw subjective trend lines. Personally, I like a lot to draw these automatic trend lines because I have no choice. I mean, I'm not selecting the line. It's the software selecting it for me. And that's the reason why it's so objective.
I think we're just about out of time, Cyril. Thank you very much for showing us another weapon to add to our trading arsenal so we can kill those black swans. And say just a thank you.
Thank you very much. Thank you.